predict the market's if you could predict the market's direction with 88% accuracy, how much money do you think you'd make? That's exactly what this strategy claims to be able to do. But here's the real question. Does it actually work, or is it just another trap? In this video, we're going to review this strategy, break it down step by step to see if it's the real deal or just another false promise. Let's get into it.
If you could have a trading system that gave you the directional bias with this level of accuracy, would that help your trading?
Okay, so let's look at that. He's claiming an 88.3% success rate with long trades. That's bullish. Sample size of 471 trades. So that's a decent amount of trades to be able to assess. And for short trades, bearish, he's claiming an 83% success rate over 488 trades. Okay, sounds interesting, but I'm skeptical. Let's see.
Now, what is the EBP strategy that has over 80% strike rate? EBP stands for the engulfing bar play. Now, there's two things we need for this system. Number one, we need to understand what exactly is an engulfing bar. And number two, the power of three concept. So we're going to talk about each of those concepts before we get into examples. Now, bullish engulfing.
Okay, so he's going to explain this right now, but another way of referring to a engulfing bar is an outside bar. Now, why would you call this an outside bar? Because this bar is inside this bar. You see that? So this would be an outside bar. That's what I would call it. He's going to call it engulfing bar. Call it whatever you want. But I like outside. And then what would you call this? Inside. Okay, so outside bar, inside bar.
Engulfing. This is a very straightforward definition. All I'm looking for is price to sweep the prior bar candle's low, and we close above the prior candle's opening price. Now, if you guys are familiar with engulfing bars or outside bars, most people will look for the closure above the high. However, for me, all I need is to see price closing above the opening price of the prior candle. It does not need to close above the high, even though in this example it did. Now, bearish engulfing. Price sweeps the prior candle bars high, and we close below the prior candle's opening price. Now, here's an example of what I just was referring to. It does not need to close below this low. Some people have that as a requirement as an engulfing bar or an outside bar. For me, I just need to close below the prior candle's opening price for the bearish side, and on the bullish side, just needs to close above the prior candle's opening. Now, this simple but extremely effective system will give you the directional bias for the next candle or candles.
Okay, so let's look at this in a little more detail. Why would that give you directional bias for the next few candles? Why? Well, because it shows you conviction. What do I mean by conviction? I mean confidence. What you need to be able to do is to be able to see what the narrative, the story that the candles are telling you. The candles are telling you a story, and it's a competition between the bears and the bulls. So it's telling us that the bears sold all the way through this candle, and this candle sold off into the close, and that's why we can see there's basically no tail, closed pretty much on its low. It's a bear bar closing on its low. So that tells you there's some bearish conviction. At least there was. But as soon as we went below that candle, and we can tell that it went below that candle quickly and then moved up. That's why there's a tail, okay? And then we can see that the price shot up and closed above that candle's high and the close, okay? And the low. In fact, it closed above everything, okay? So what this tells you is that the bulls, there were buyers down here below this bear bar. And that as soon as we got below this bear bar, we shot the price up. And not only that, okay? But the close of the candle is the most important information. So that also tells you that they continue to buy, 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 continue to buy all the way through. If this is a 5-minute candle, let's assume it is, that for all that 5 minutes, the bulls were buying into the close. Okay, and you got a little tiny tail as well. So that shows strong bullish conviction after strong bearish conviction. And when you're trying to assess bias, you need to compare the bear case and the bull case. You got to put one in each hand and you got to compare them and say which one's stronger. This tells you that there were sellers and the bears were strong, but the bulls were much stronger and they were waiting here to take over control. So that's what that tells you. And so that's going to give us some sort of confidence that the bulls are in control to some degree for the next few candles. So that's why it gives you bias. Okay. It gives you bias because all it says is that the likelihood of the bulls or the price going up is higher than the bears selling and taking the price lower. It's just telling us that one outcome going up is more likely than the other. Okay. Going down.
Bias for the next candle or candles. Now, before we get into that, the next concept we need to understand for the system is the power of three. Some of you guys may be familiar with this concept and some of you guys may not, but I'm going to go ahead and walk you through it. When we talk about the formation of a bearish or a bullish candle, we have this very basic framework. Typically, on a bearish candle, what we're looking for is a candle to open up. We want to see a push higher into some sort of key level typically, and then the market has some sort of drop lower, right? We form some sort of low and then we close bearish. Now at one point during this candle's formation, if this is a daily candle, a 4-hour candle, 1 hour, 1 minute, it doesn't matter because at one point this candle is actually bullish when it was pushing up. However, that push up is usually some sort of manipulation move to drop to head lower, and then whatever low forms and we close on the bearish side. Inversely, on a bullish candle, what we have is typically the opening price. We have the drop down first, and then typically price will create a high and then a close. This drop below the open and this rally above the open is what we call power of three. While the candle is forming, we're looking for the market to have some sort of drop lower in the bullish example to create a bottom wick before heading higher. And inversely on the bearish side, we want to see the market have an opening price, rally first to create a top wick, and then we have the market head lower. Now, this is very important because we will use this concept to frame potential trade ideas.
Okay, awesome. So I've got the whole strategy mapped out for you because I want to make this crystal clear. And my goal with this video is to make his video 10 times more valuable so you're 10 times more likely to take something from this video and make some more of this. So we start with the main concept, which is what? The engulfing bar play. You know what an engulfing bar is now. And then we see that it utilizes a combination of two things. One, the engulfing bars, and the power of three, which he just explained. And now we'll get into the core components of the EBP strategy. As we've mentioned, there's that engulfing bar, which is a price reversal signal, which I just explained to you. And then the power of three, which he's just explaining right now. Now, when we look at the power of three, okay, he's explained that the candles form in three key phases. Open, manipulation move, that's the wick creation, right? And then expansion in the true direction, okay? And then there's the bullish move, which is the wick down followed by a strong move up, or the bearish move, which is a wick up followed by a strong move down. Next, we've got method one, which is trading the EBP for a daily buy. So now we're going to take these concepts and learn how to apply them to actually placing a trade, that's what we want, okay? So let's see how we can actually make money with this thing.
When we combine the two concepts into the EBP play. Now, there are two ways to trade the EBP system, and here's the first one. The method one, trading the EBP. DOL stands for draw on liquidity. Where is the market headed to next? So with the first model, I'm using this system to help me identify where I'm going to typically enter and where is the market likely to head to next. And for this method, I typically use the monthly time frame, the weekly time frame, and the daily time frame. So these are very specific to method one. Now, for the sake of time, I will focus on the first method in this video because I don't want this video to be way too long. But if you want the video for the second method, join my public Telegram, link in the description below for when that video upload is going to be ready. And if you're watching this video at a later date. Now, method number one, DOL, trading the EBP. Now, right here, we have an example of an engulfing bar. And again, guys, this is what I mean. I just need the bar to close below the opening price if it's a bearish one. It doesn't have to close below the low. And this is just a good
inside, outside. Outside because it went above and below the prior candle, right?
Example of this right here. Now, with method one, what I like to use is the engulfing bar candles low. In this bearish example is going to be my DOL. So this is typically going to be my objective or target. Now think about it. What time frames did I tell you guys that I typically use this on? the daily, the weekly, the monthly. Now, if this is a daily bar or a weekly bar, this draw on liquidity can be very, very important because it gives us the framework that this could be our next target. Think of the statistics that we talked about in the beginning, the 88%. On the bear side, it was around 83%. This is the DOL that this statistics is running through. Now, again, if you guys stay to the end of the video, I'll tell you guys exactly which asset class this pertains to. But the sample size is 471 on the bullish side, and for the bearish side, 83.4% accurate. 488 examples. So, and this is using a daily bias. So that DOL, depending on the asset class, has up to 83.4% of being hit. That gives us a massive edge because we understand we now have a draw on liquidity in price that we can anticipate 83% of the time. So going back to...
Okay, now one thing you want to keep in mind when someone mentions their win rate is what is their expectancy? In other words, what is their average profit per trade? Because if I make $1, okay, if I make $1 every time that I place a trade, but every time that I lose a trade, I lose $1,000, that's not good. In other words, you can have a 99.9% win rate and still be losing money, okay? So this is one of the reasons why I make these videos is because I don't want you guys to get tricked like a lot of new traders do. When you see a high win rate, that doesn't mean anything. We need more information, okay? So let's wait and see what he shares with us about how much money the system actually makes, because this strategy, literally, and listen to me here, literally with an 88% win rate could be unprofitable. So we need more information.
To this example, we understand that the DOL on this example is going to have an 83.4% likelihood if it's on a specific asset class. And to be honest, guys, I've tested this on multiple different asset classes. I have a bunch of data, and I'll probably, if you guys want the data, comment data in the comment section, and I'll see if I make a video explaining all the data that I have for every single asset class and its accuracy. However, knowing that this DOL has over an 80% likelihood of getting hit gives us a massive edge. Now, how can we use this to our advantage? What I'm typically looking for is the next candle or the next few candles. Sometimes it won't be the next candle right away. I'm just looking for the candles open, the price to rally first, and then drop into the DOL. Now, again, this is why we use the concept of power of three, because I need to see the candle opening first, head higher first, and then hit the DOL. If typically price drops lower first, takes out the DOL, in some cases, I'm no longer interested. In some cases, I am. It's going to be dependent more so on the higher time frame, but that will be something that we talk about later. Now, the key thing is this. We take the engulfing bar candles high and the low, and we essentially map out the 50% of that prior candle's range. This will give us...
Okay, so what is this? This is a 50% pullback. Now, if you don't know about 50% pullbacks, you need to. 50% pullbacks are commonplace in trading, and they're a great strategy to work with because their price is always making 50% pullbacks. It just happens all the time. So what you see is that the price went down, and he's saying when the price goes down, it makes a decent move down, which it did here, from here to here. That's a move down, right? He puts his order at a 50% retracement of that move down. So the 50% pullback would be here. And all he's saying is he's going to enter on a pullback of this move down. 50% exactly, which is a great strategy because, as we said, the market's always making 50% pullbacks. It's very common. Now, the price might not actually get all the way to that point, but more often than not, it will.
Somewhat of a reference point to look for. Now, there's a lot more that we can do with this on the lower time frame, but just understand the concept. What we're looking for is the price to have an opening. Price on the next candle rallies up into near the 50% mark, and then we head lower to that DOL. Now, again, guys, this is going to be on the daily, the monthly, and the weekly time frames.
Okay, cool. So we've got some more details now for actually how to trade this. You can see that he's using the daily, weekly, and monthly. It determines where the price is most likely to go next using that draw on liquidity. And the key process includes 4 things. 1, identifying the engulfing bar. 2, using the low or the high of the engulfing bar as the draw on liquidity target. Applying the power of 3 to confirm entry points. and then watching for the price to wick into a key level before moving to the draw on liquidity.
I personally like to use it on these time frames. And the second methodology, we'll talk more about the 4 hour, the 1 hour, the M5, M15 if you want to go that low. It's going to be dependent on how you want to do it. But this is just method one. This gives us directional bias accuracy with over 80% on the bullish and the bearish side. Now, let's go ahead. I'm actually going to take you guys through a few examples on TradingView. So here's a chart of NQ on the daily time frame. Now, as you guys can see, based off of the description of the engulfing bar, we have one that's printed here. Now, if you're wondering what this is essentially like the indicator that I have specifically just to plot out the engulfing bar and give me alerts across my watch list. But again, if you're more interested on that, check the public Telegram. I'll probably make a video on the indicator and post it somewhere in there. Now, the key thing that we have to understand, when the engulfing bar forms, what is the exact requirements? It must take out the prior bar's low in the bullish example, and we close above the opening price. Now we have the engulfing bar. Now look at the concept of the power of 3. And in this, I'm going to show you guys multiple different examples. But again, I want people to understand this one key component. This is just to give us the directional bias. I'll make other videos in terms of how to enter, but I want to show you guys how this can be used to create a very high probability daily bias. Now, the next candle opens up. We have the wick lower, so we have the power of 3. Now, these dividers in here, there's the 25%. So let me go ahead and mark this out for you guys. This is 25%. This is the 50% mark in here. And this is the 75%. So the engulfing bar candles high. Again, this is going to be our DOL. So let's go ahead and map that out. And we know this is going to be our potential objective. Now look how the market drops lower inside of this overall area. And then we have a push higher. And we're going to see as we play it forward, beautiful. The market hits, that counts as a win. When now the indicator also plots across the board. So look at this bullish example. Price had a bullish engulfing because we swept the prior bars low. And we had a push back up above the opening price and a closure. Next thing we know, we have price comes up and we take out the high of the engulfing bar. This is an example of one that actually did not work, where there was a bullish engulfing bar. It's fine. It's not going to be 100%. When we play it further, we have another one right here, which plots out. We take out the prior bars low and we have a close above the opening price. Even though this candle was bullish, right? The opening price was here. So now what happens, price comes on the next candle, we take out the high. And even then, we still respect this 50% and we have a move higher. Here's another example. We have a bearish one in here. Price actually...
No, I love these candle patterns. But here's the thing, when we get so lasered in on these little teeny tiny patterns, sometimes you lose the forest for the trees. In other words, sometimes you get so focused on one or two candles, you lose touch with what's happening overall on the chart. And if you're learning this strategy and you're a beginner, I want to remind you that what's most important for placing a trade always is the context. What's most important about any chart that you're looking at, if you're trying to make money with it, is the context. In other words, these engulfing bars or these outside bars are really useful, as you can see. However, you need to be able to see what the overall pattern is. And what we can see here, okay, the overall pattern is up. Can you see that? Do you understand that this is a bull channel? Now, why would I say that? Because we've got a low here. Now the low's here. So we've got a low that's higher than this low. And then we made a low here, which is higher than this low. So the lows are getting higher, which means we have what? Higher lows. And then this was the high. Now this was the high. This high is higher. So we've got higher highs. Okay. So overall, we've got a bull channel. So that's more important than noticing these little teeny tiny candle patterns. Ideally, what you want to do, though, is to be able to put both together, because the overall pattern gives you the context, which is thing number one. And then thing number two, which you want to add to the context, is the momentum, which is what's happening right now. So what's been happening, context, and what's happening right now. And that's what I want you to add to this, is a essential understanding of what is happening overall, okay? Because yes, this is going to tell you the bias for the next few candles, which is great, but you also want to be able to see what the chart is doing overall, and you don't want to miss that, and he's left that out.
Higher. Here's another example. We have a bearish one in here. Price actually closes next to the 50%. What happens? Price comes down, takes the liquidity that's resting below that low. We have another one that forms. Price closes again near the 50% mark of the overall candle range. And we have a drop lower and actually drops even further to fill in this void. Again, guys, this, you guys can go ahead into your charts and actually test this for yourself. We have another bullish engulfing that forms. Then next candle, we have an opening price. Price rallies up, takes that liquidity. And this is the key component that I want people to really understand. I want to see the market open up. We have a drop lower first, and then we have the expansion to the candle's high in this bullish example. So on the lower time frame, if it comes down to the 25%, 50%, we can use that to frame a bias. Now again, this video is not going to be just about entries because I have to build it. So this is going to become part of a series on the EBP. So again, make sure you guys are subscribed because I will be dropping, first of all, the method number 2 and how to enter these on the lower time frame using trading models and daily profiles. Now, we'll look at one more example in here. We have price takes out the bar low. We have a push above the opening price. Look how the next candle on the power of 3 comes down into the 25% and then has a push back above. It doesn't always have to go to the 50%, but as long as it's within this overall region, we're seeing price come down into this area and then have an expansion move high.
Okay, cool. So we got the engulfing bar play. Okay, so you've got the details of that locked in. You saw that his back test win rate was an 88% win rate with those bullish engulfing candles, and it was an 83% win rate on the bearish engulfing candles. Now, I don't see the data. I don't think he showed us the data. So we just have to take his word for it, which is a very bad idea in the financial markets because there's a lot of shenanigans. So you don't just want to take someone's word for it. So, you know, I would want to see the actual data there because, well, what if he just made it up, right? Okay, so let's just assume that there's more information that we need in order to really be able to tell if this is for real or not. But going through those examples, you could see that he's repeating these same patterns and taking the same trade over and over again. And the pattern works the same way, whether it's bullish or bearish. And the key point there is it doesn't matter whether you're long or short. The patterns are the patterns. So if you find a pattern that works for long trades, then more often than not, in fact, in nearly all cases, it's going to work for long trades and short trades. So those are our examples, and you can see that with example 1, example 2, and example 3. Now, what are our key takeaways? Trading is a probability game. Not every trade wins, but with an 88% win rate, this system does give you a major edge. Now, assuming that this system does give you a major edge because we didn't see any data and we're just going to take his word for it. I don't know about that, okay? However, remember what I said. A win rate means nothing without the average profit per trade. So I want to show you exactly what I mean by that, okay? Because just seeing an 88% win rate is impressive, but this is how new traders get taken advantage of. So I want to show you some data right now that I collected from the Top Step Facebook group from other traders that post their trades. And we're going to look at some data of high win rates from traders that are absolutely awful. Because what I want you to see here is that a high win rate doesn't mean anything and that you can actually be losing money with a high win rate. So let's look. You've been lied to about the importance of your win rate in day trading. In this video, we're going to talk about the dangers of putting an emphasis on your win rate and what to focus on instead. I was recently asked about my win rate, and I'll put it on the screen here. So first, this is my win rate over the past. Now, is that good? Is a 50% win rate good? Well, okay, so this is my win rate over let's see, 65 trades, okay? Now look, this is a 50% win rate. That is so much less impressive than an 88% win rate, right? If you took 2 traders, me and let's say this guy, and you were like, hey, who's a better trader? Well, obviously he is because he's got an 88% win rate. Not true, okay? What matters is this number right here, the expectancy, which is your average profit per trade. It depends. Let's have a look at the win rates of some other traders posted in the Top Step Facebook group, the company I earned the funded account with. This trader has an 81% win rate. Okay, 81% win rate. Is that good? I mean, his win rate is clearly better than mine, much better. So that must mean his trading is better too, right? Well, no, actually. How can we tell if this win rate is good or bad, right? Whether it makes money or doesn't make money. We have to look at the average winning trade and the average losing trade. Now look at the average winning trade, it's $41. Look at the average losing trade, it's $43. His average losing trade is bigger than his average winning trade, okay? So that means that he's only making, if we put those two together, all 3 numbers put together, give us our average profit per trade or expectancy. It's the same thing, okay? Average profit per trade or expectancy, $16 per trade. Okay, $16 per trade with an 81% win rate. What? Now let's go back for a second. My win rate was in the 50% range, right? 50% range. But my expectancy or average profit per trade is $45. So I'm actually more effective than someone at 50% win rate than someone with an 81% win rate. You guys get what I'm saying? Let's look at a couple more examples.
1% win rate. Is that good? I mean, his win rate is clearly better than mine, much better. So that must mean his trading is better too, right? Well, no, actually his expectancy is $16. So even though his win rate is 81%, based on these stats, he actually averages almost $40 less per trade, showing clearly how misleading win rate can be. Now, how about this trader? His win rate's 62%. Still significantly higher than mine, right? But look at his expectancy. It's only $3.29.
$3 per trade. That's it. With a 62% win rate.
And if you put his stats head to head with my stats, again, even though his win rate is still higher, his profitability is not. Now, this trader has a win rate of 41% with an expectancy of $11. So there, you can see a lower win rate than my data, but based on these stats, his performance is still profitable. In fact, even with the win rate of 41%, his expectancy is almost the same as the trader with an 81% win rate.
Now notice, okay? I just want to underline this. The trader with a 41% win rate and the trader with an 81% win rate, okay? That's like double are basically making the same exact amount of money within a few dollars, okay? So if you can't see how misleading win rate is with that example, I don't know what to tell you.
So you can see clearly that when we stack these examples, it's just obvious how incredibly misleading and often arbitrary even win rate actually is. Here's the problem. Your win rate hides the effectiveness of your trading. And why is that? Because you can have an 80% win rate and still be losing money. So
you can have a 99% win rate and still be losing money, okay? I think you guys get the point. You can head to my other channel, Trades by Bren, and watch this video if you want to see the rest of it. But I hope that I made my point to you about high win rates being misleading. And my goal in sharing that with you is that you don't get misled, because win rates are very misleading. But that's one of the differences that I'm out to make here on YouTube, is to help new traders not get tricked, okay? So focus on higher time frames. Back to this EBP strategy. Focusing on higher time frames first for accuracy before diving into lower time frames. That's called top-down analysis. So you look at the daily chart, then you go down to, let's say, the 1 hour chart. Then we go down to, say, the 15-minute and then the 5-minute and place our trade on the 5-minute. And we're looking for a narrative that we can follow all the way down. Next, engulfing bars and the power of three together are what create his winning formula, assuming that it's winning. All right. So that is the EBP strategy. Now, if you want more info on my strategy, go to tradesbybren.com, and I have a free downloadable PDF where I will share with you my 3 favorite trades, including the 3 patterns that I look for, how I set my stop loss so I limit my risk, and how I set my profit target so I can get out before it's too late. Again, it's tradesbybren.com for that free download, or just hit the link in the description and you can check that out. Hit the like button if you liked the video and subscribe for more, and I'll see you in the next one.